Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Welcome to the land of opportunity, rumors, and fake news, whatever it is out there. But there's a lot of it going. Gee whiz. Just remember what Thomas Jefferson said, folks. Any market that can give you 1,200 points can take away 1,200 points. I still stick by my prediction that before this leg is down, we will see minus 1,900 in the Dow Jones someday. Probably soon, maybe sooner than later, but that's my prediction. All I'm doing there, folks, is I'm taking the largest swing thus far, multiplying it times 1.618. And there you got, it works pretty good most of the time, but who knows? There's a lot of things happening, of course, as you realize that is going on in the news. I've posted both the DAX and the FTSE. They're actually holding up much better. These are a little late, though. They backed off from those levels quite a bit, as you can imagine. But, we're still holding up relatively well, folks. If you look to see where we were last Friday, let's just get this up here to take a look at. By the way, we will have Bill Meridian as our guest today at the half-hour break. And so if you have any questions, please get them ready because I'm sure he'll be able to help us. Okay, this is that low that we hit, that exact 50% level there at 28.55. From there, we rallied all the way up to 31.37. Yesterday's high came in at around 31.15. And the NASDAQ was just a little bit below that. But to me, these are just big corrections that we're having in this longer-term move that we see happening here. It's not the end of the world, folks. But I mean, you're starting to see crazy stuff now here in Tucson. Costco's and Walmart's have ran out of paper, toilet paper, and also paper towels and stuff. You can't even get $1 and $5 bills. The only thing that they have now is 10s and 20s. It's getting pretty serious out here. So let's pay attention to what's going on. This is going to work itself out, but how long it's going to be? What's problematic here from my point of view is the news now, because they don't have Trump to beat up on it for at least another month or so. So they've got to use something else, and so they're using that. And the news that's coming out. I mean, first of all, the quickest way to start a pandemic or something is tell people that there's one here or it's coming. By the time that World Health Organization announces there's going to be a pandemic or we're in a pandemic, the stores are not going to have anything in them anyway. So make sure you have some cooking oil, peanut butter, rice, pasta, canned goods. Water is okay because you can get that off the tap, and some paper goods if you can. And I don't know if it's going to come to that, but what the heck, you got to protect your family if nothing else. Also have some paper money in case you have to, buy things where the stores are closed. You just don't know. I don't want to scare anybody, but, you listen to what's going on in the news, you think it's the end of the doggone world. Remember, in 1918, we had a Spanish flu that killed 50 million people. This is when we didn't have a lot of people on the planet. There was only 108 million people in the United States during 1918, and we lost 750,000 700,000 people died of the Spanish flu in 1918 because remember, we didn't have the hospitals and medical stuff that we have nowadays. But who knows what this thing is going to do? And the problem is you're getting such strange information. One person says, oh, it's going to be okay. The next person says, oh, this is the end of the world. I mean, who do you believe? I don't know. So let's pay attention. Let's look at what might happen. And I'm just not saying this is going to happen. Let's see what we might happen. If we take a look at this will be the Yeah, that most of the Costco's that was pretty much nationwide, I guess, from what I've understood, from what people have told me. Here is what we're looking at, folks. We got up to a 31.37. Yesterday's high was a 31.15. We're trading around 30.50 or something. I don't know where we are now, but if we get below 28.50, that's going to be if we get below 28.50, we'll make that D point very, very quickly. That comes in at 25.75. There's double numbers there. There's a 1.27. See, I marked it in a red box. A 1.27 and a 1.618 is where we're going to go. And that will be one heck of a buying opportunity, I believe. How much of a bounce, I don't know. But if it gets there, that would be a very, very bullish pattern. In fact, it would be the biggest ABCD correction since 2011, I believe, when we made a 382 retracement of the move from 2009. So that's really what we're watching. The thing that you have to really pay attention to is what's in the news and where it's coming from and who's saying it and what is the ulterior motives on it. Today, I understand that in the United Kingdom, the second largest carrier over there of the regional carriers went belly up, and that's pretty tough. Also, we'll just move on. See, folks, it's not the main thing is if we break below 30, that's a really bad sign. Maria, it really is. And let me give you my 2 cents worth. Watch the price of 30.61. Okay, watch that price very, very closely. That's the one that my key on. If we don't get above 30.61 here in the first couple of hours, that's a really bad sign, and that means we're probably heading down, for the rest of the day. But that's still, we'll be able to see. We could, who knows what you could see, folks. These markets are very jumpy. Look, can you realize we're having 1,000-point swings like it's nothing anymore? This is the volatility that you dream about, but, it's not going to stay this way forever. But, when these things go, I don't know. Let me explain something to you, folks. All I know is this. Let me get this up here. I want to get this up here and show it to you right here. I spent a lot of time on this last week. Okay. Last Friday, you'll notice that the New York Stock Exchange Index hit an exact 0.618 retracement. We rallied just about 50% back from that level. But every single index that we have, the Dow Jones Industrial, which is the smallest of the group, the second smallest is the NASDAQ, and the third smallest is the Russell, and the biggest one, of course, is the S&P 500. They all hit perfect numbers. If you looked at the big FANG stocks, Facebook, Amazon, Apple, Netflix, Google, and throw in Microsoft, they all hit perfect Fib numbers. I posted these in the newsletter, and so let you look at them. How often do you see that? From that level, we had this big rally, and not only that, but Sunday night the market backed off and it looked like it was going to take out those lows, but it couldn't, and then it took off. So somebody has put a great deal of money in this market to see that it stays above those highs of the lows we made on Friday. But if we take out those lows that we made on Friday, buckle up, because we are heading down, but that ain't happening yet. So we'll be right back. 877-927-6648.
If you're not currently using the TAS Profile Scanner when looking at setting up your trading opportunities, then your arsenal is short a mighty weapon. The TAS Profile Scanner is a standalone piece of software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Headed by Steve Dahl, TAS understands that in today's technological world, the use of top-flight software applications and technical analysis expertise is essential to successful trading in today's market. You also gain access to the webinar that Steve Dahl and Tom O'Brien just hosted, The Best Way to Use the TAS Profile Scanner to Profit. This webinar archive is available for all subscribers immediately upon signing up. All new subscriptions also come with a 30-day money-back guarantee, so you have nothing to risk. Start your subscription by visiting the front page of TFNN.com today, and you'll find the TAS Profile Scanner under the Services tab. Sign up today. Are you in the market for buying or selling real estate in the Bay Area, including the surrounding St. Petersburg, Tampa, and Clearwater markets? Tiger Real Estate LLC is a firm that has extensive experience in the Tampa Bay area. Whether you're looking to sell your current property for maximum value, or you're in the market for a second home or investment property, Tiger Realty has the experience across all areas of real estate in the Tampa Bay area to help buyers and sellers make the most informed decisions across all price levels. From the price you should be paying per square foot in certain up-and-coming areas to the type of cash flow investment properties are capable of creating, Tiger Real Estate can help you make the best decision when it comes to all areas of the market. Before you make one of the biggest decisions of your financial future, call Tiger Real Estate LLC today at 727-329-8322 or email us at tiger@tfnn.com. That's 727-329-8322. Call us today.
Many of our new listeners have heard about The Tiger's Den. The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of the TFNN shows, plus see all of the charts as they happen live and have access to archives of all of those charts. You can test drive The Tiger's Den absolutely free for 30 days and greatly enrich your knowledge of these markets and how to make your money work for you. Details on The Tiger's Den are on the front page of TFNN.com.
TFNN has launched our brand new website. You can still visit us at the same TFNN.com URL, but when you do, you'll see a new and improved homepage with a much simpler navigation, whether you're watching Tiger TV live in high definition or just accessing your newsletter subscriptions. We even have new pricing in 6 months and yearly options. Check out the new TFNN.com now and experience all the upgrades. TFNN.com, educating investors.
Call now, toll free at 1-877-927-6648. Internationally at 727-873-7618.
Okay, folks, I posted a couple of charts that Shane Smolian, Wolf Trader, sent to me, and I thought you'd take a look at them. The second one is interesting because it shows that the global death versus the total recover is pretty good. And if you look at that right one over there, you'll see that the recovered patients, there's a good recovery. In other words, the death rate is not nearly as bad as some of the other things like Ebola and other things going on. Let's talk about the markets. I don't particularly like to get into this stuff that we're looking at today. We'll see here what we're going. We're breaking down. We're getting near that 30-30 level, folks. We get below that, then we're looking at something pretty serious here to the downside, in my opinion. So pay close attention to it. Let's talk just a bit about the bonds because we got down close to that. We're down below 1% now. Folks, the open interest in the Treasury bonds is dropping. And with prices going up and open interest dropping like that, that is not a, maybe it's different this time. I don't know, but they're not, there's no new buyers coming in. This is short covering, and in all of them, the 2-year, the 5-year, the 10-year, and the 30-year, all of them dropped in open interest. That's not a good sign. So that's important. Also, on the rally in the S&P yesterday, as big as it was, there was a drop in open interest in that one, 2 days in a row on those two big rallies. So, again, that's short covering again. So we'll see, what happens to that. But we'll have to do one thing at a time, I guess, and we'll, go from that level. But that's what we're paying attention to this morning. Let's take a quick look here at the S&P here to see what our next level of support would be, just to see where we are, because we should be getting close to we're way up here. Shoot, what are we talking? There's no disaster going on here. Shut the front door and raise the rent. Let's get this up here. Oh, we're right at the 61% retracement right now here. Let's just get that here. Let the boys and girls that like Fibonacci take a look at it. I don't know if it's going to hold this or not. that was very good. David White just posted the quote by Mark Twain. The reports of his death were greatly exaggerated. That's a good one. So if we get much below 30.32, that tells you that this the 30.31, that tells you that this fib point is going to break, and then we're going to see if that's it. It's amazing with the big strength that we had yesterday. even with that strength, we could not take out the highs of March the 3rd when the Federal Reserve came in. And then you notice the market came down and touched the fib point right there yesterday. On the 3rd, and we got down to 29.70, and then we rallied back up again. So this is the key level that we're at right now. If we go much below that 30 level that Maria talked about, we're probably going to break a whole lot more. Folks, we're going down. It's a question of whether we're going to go today or tomorrow or the next day. But the key price on the upside today is 30.61. That's what I'm watching. So if we can, if we don't get any higher than 30.61 today on any rally, that would be a negative in my opinion. But again, this is my opinion, and it doesn't count because it's your money and not my money. So the crude oil, we've been short that for quite some time. And I still believe we're going to go probably lower, but I would put your buy stops in at 47.28 just to protect your protect the profit. That would be a profit of about $1,300. So if you're in that, make sure you protect your stop at 47.28. We'll have Bill's in Vienna, Austria. Bill Meridian from Cycles Research. That's where he lives. So he'll be there with us here in about 8 minutes, and he'll tell us about what's going on with it. Well, he might even have been there this morning. I don't know. I didn't see him when I was watching Bloomberg, so we'll keep a close eye on that one as we walk through here. Also, keep an eye on gold and silver's not acting too well, nor is platinum. Looks absolutely horrible. I sent out a video about that last night that the platinum looked like it was ready to go, but we're getting up to a really near a very important number here at 1561 in the spot April gold, because that's going to be a very important 78% level. If we get above that, that tells us we're probably going to break out to the upside a little bit more, but it should have a little bit of trouble up in that area. The other one, folks, the U.S. dollar something's getting ready to happen to the U.S. dollar, and I'll tell you why. The euro and all of these other currencies that we look at, the euro, the yen, and some of the others, there's a real battle going on. And if you look at the U.S. dollar here on the daily chart, after we made that big ABCD pattern from January into February the 24th, we completed that ABCD pattern. We dropped from 99.80 all the way down to 96.90, and you notice this little 2 or 3 day bounce that we have has really done very little. And the euro is just hanging there. There's no correction in the euro at all. I mean, after 14 days up, you think there would be some type of a correction in the euro, and there isn't. So that's telling you that U.S. dollar could really start to get moving, and that's not to the upside. That would be to the downside. So that's all I'm saying. There's something really big going on there. And we see that the same thing, with the Japanese yen. Let's look at this Japanese yen. It just will not give up. We'll bring up and take a quick look at it here. Oh, I do want to talk about some of the commodities here. I will do that very next here in just a second. There's the yen. I wanted to discuss the soybean meal because there's a very, very beautiful pattern here in the soybean meal, and it's called just a tad lower this morning, but this is a beautiful 135 pattern, folks, over the last 9 months. You can see 0.1, 0.3, 0.5. 3 is 61%, 5 is 61%. My goodness, you can't get any more perfect than that. And if you look at the time between September and October, that took it's exactly the same as what we had between this 2 weeks here in February. Now, the fact that it came out of here this strong, much stronger than it did during September. You see, this has been straight up right away in 2 weeks. And this is in the midst of, embargoes and tariffs and viruses and supply chains and everything else. That's a main thing to look at. Also, those of you, we're not going to have time to look at coffee, but take a look at coffee. Completed that beautiful Gartley pattern. It's had a nice move. And we've got one of those completing in wheat now. Look at your May wheat, folks, down here at around this 518 level. You don't have to risk very much to be a farmer at that level. And finally here, before we get to Bill Meridian, let's take a look here at the Dow Jones Transportation Index. People still have to eat, but you know what? They got to be able to buy the food because we don't grow it ourselves anymore. You'll notice here that all we did with the transportation index is we made a 382 retracement here on Tuesday, but we didn't go any higher than that. So this is still the most bearish of all the indices. And if we do break below those levels, that's going to be really tough. So if we break below that 30-30 level, that's going to tell us that there's trouble in River City, and then we will know whether that is going to be the big kahuna or not. I haven't decided whether. Let me see if we can get this thing up here so I can see it. Window, tile, vertical, and well, we've held that 30-30. We had that 61% retracement, spot on. So as long as we don't get below that, you know, we're all holding up okay. That's the way it looks like.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he's watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. If you're a trader in the market looking to find the path that leads to maximizing profits while decreasing risk, then now is a great time to try out Dave White's daily trading service, The Path of Least Resistance. Through the use of options and equity trades, Dave advises his subscribers on a daily basis of the current market conditions and what possible trade setups are on the horizon. The Path of Least Resistance is published every trading morning, often with updates intraday when initiating trades or closing out positions. Dave White has advised his clients of some outstanding winning options and equity trades in recent months, and now is a great time to try it out for yourself. New subscribers to the Path of Least Resistance receive a 30-day money-back guarantee. See for yourself the types of options and equity trades that are available by signing up for the Path of Least Resistance today by visiting the front page of TFNN.com and selecting the newsletter tab. Sign up today. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks. We have Bill Meridian, Cycles Research, on the line. Bill, is the volatility enough for you, my friend?
No, I'd like some more.
Go ahead. Tell us what you got for us today, buddy.
Okay, well, let me just open up my presentation here because I forgot because now I wrote it yesterday. Okay.
You're talking about the bullish cycles dissipating.
Yeah.
That was a
we're today's perspectives. That's page 2. Stocks, I think, are likely to fall short term, but I'm more constructive longer term. And bonds we'll see below appear to be declining in March, although they're not right now. And gold is likely to rise in 2020 to 1800, 1850. That I think that will likely be by May 1st, but it may be a little later in the year. So if we go down one slide then to the cycle, the cycle schedule. Well, the bullish cycles obviously have dissipated. This is a repeat from the last time I was on, and the weekly and the monthly cycles have topped, as we'll see. The 12-year cycle is in a down phase for the first 2 months of the year. That is actually described by the planet Jupiter, but I'm saying 12 years instead of Jupiter. And the 1.6-year cycle is in a declining phase until Q1 of 2021. That's actually Mars through the signs. 2020 is a year ending in a zero, and such years have had the most bearish returns of any years in the decennial pattern. That is, years ending in 0, 1, 2, 3, 4, 5. And and this is also a repeat, but it leads into something else on page 4. We have the contrary opinion sell signal. That is January issue of Barron's, Dow 30,000. And you remember, I showed this last time, 1 month ago when I was on. Here's a new one on the next page. Big Tech's $2 trillion bull run. That was the front page of The Economist from February. And of course, technology is the most overbought. And for those of you who the sentiment opinions might be new, the late Paul McRae Montgomery of Newport News, Virginia, did a study of the covers of 3,200 Time magazines. And he found out whenever there was an investment-related story on the cover, that the investment went in the reverse direction to that which the cover suggested within 2 months with an 80% accuracy. And so here you have two. One saying the Dow's going to go over 30,000, and a second pointing out the strength in the technology stocks, which were up almost 50% last year. And here I have further signs of a bubble. You know, I've had a whole series of these. I just got some new ones this morning. This is a Border Collie, Megan, selling for 18,900 British pounds, which is about $22,000, the highest price ever for a sheepdog. I mean, you know, when the money is cranked out at the Federal Reserve, it goes everywhere, and you can't guess where. And that's when I go to universities. I said, if you guys could invent, I explained that the excess creation, of credit, is the definition from the Austrian School of Economics of inflation. In other words, it's excess creation of money over and above the money that is needed to effectively transact business in the economy. The excess spills over into speculation. And if you remember, in the 70s, it was commodities, collectibles, and in the 80s, it was consumer stocks, the 90s, technology stocks, then it was energy stocks. And now it's just going all over the place. These are called Cantillon effects, named after the economist Richard Cantillon, who first described this, that excess credit goes into different asset classes. You know, you're sitting there in an antique store, and suddenly the price of antiques goes through the roof. Or you're selling gold coins, and suddenly gold coins goes through the roof. I said, if they could figure out a way to figure out where this money is this excess credit will go in the next cycle, they'll really have something. So let's go to the markets right now.
Okay.
Here's the weekly and monthly S&P cycle and the monthly S&P cycle. And I was calling for, as you know, a decline, and I was looking for the first low was indicated somewhere in the second or third week of March. This is where I'm getting this from. And if you go one below, now these cycles are created from, I just ran them yesterday. So they don't include yesterday's data, but they include the most recent data. And the cycles are tested on a buy and sell signal basis for how much money they'll make you. So that's what that dashed line is. That is where I start. Now let's go to the other cycles. This is where I began, and I migrated into the prior technique. There's the one-year cycle in red, which is the annual cycle for any year. The market usually bottoms in the summer, it rallies, it corrects in September, October, as everybody knows. And then there is the 4-year cycle, which is supposedly caused by the elections, but as the late Ian Notley pointed out, there's a 4-year cycle in societies where there are 4-year elections, 6-year elections, 8-year elections, or no elections at all, and it existed before the establishment of the Fed in 1913. So it's not being caused by the election year. There just happens to be a 4-year cycle, which is actually pointing up this year. And then the green line is the 10-year cycle. Years ending in 0 have the most bearish returns. You can see that green line falls all year long. Now, the sum of these is below the top graph, the top strip. And you see that late February low. We're already at late February and already in that early March rally. So this differs a little bit from the prior cycle, which is the dynamic one. This shows that the market's already bottomed. The other one suggests that the market is going to turn down, and I think that day is, in fact, today. And I think the low is around the 16th to the 18th of the month. And this is what I wrote last weekend to the institutions. I suspect that the S&P will retrace part of its losses for the first 3 to 4 days of the new week. We're now at day 4. The month's end strength takes effect from the 27th into March 6th. In other words, February 27th to March 6th. This period has risen. This is number 2 of all the end-of-month periods, up 68.6% of the time. We just saw this, for an average annualized expected return of 26.8%. Supporting this notion is the indication U.S. notes have temporarily topped. We'll get to that below. In addition, the S&P is at a 50% retracement level of the 2018-2020 rally. This will likely provide temporary support. Now, there are some signs that the excessive sentiment tide is rolling back. It's not rolled back enough. Last Friday, Wall Street analysts lowered price targets to 53 more stocks than they raised price targets on. That's price targets, not earnings. The AAII Sentiment Index, which comes out tonight, dropped from 40% bulls to 30%. That's good, but lows are usually triggered when that percentage is in the low 20s. And I had written that call buying was at an extreme. The level has fallen by 52% in a week, but it's not at a buy level yet. So traders are paying now more for calls than they are for puts. So if we can go to the next graph, that is the decline, and you see that it has, number one, it has gapped down and then sort of gapped down again and retraced part of that. And one thing that Elliott will tell us is a huge move like that coming off of an all-time high. Go sell some stuff.
Hey, we're going to. We'll be right back with Bill Meridian, Cycles Research. Stay with us, my friend.
If you're in the CD market and looking for a secure investment, the Tiger First Mortgage Program may work for you. The security for these first mortgages are building lots in the Tax Opportunity Zone in St. Petersburg, Florida. The Tax Act of 2018 set up tax-free zones across the country where you can build and hold for 10 years and pay no tax on the profits, which makes these lots valuable. The investment is anywhere from $30,000 to $75,000. The interest paid is 7% yearly, paid on a monthly basis. According to Bankrate.com, the best rate for a 4-year CD in the country as of February 20th is 3.1%. A $50,000 investment at a normal 4-year CD rate of 3.1% would give you income of $1,550 per year or $6,200 over the 4-year period. That same $50,000 investment in the Tiger First Mortgage Program would give you $3,500 per year or $14,000 over the 4 years. Which would you prefer, $6,200 or $14,000 of interest on your investment? If you would like more information about the Tiger First Mortgage Program, you can call me at 877-518-9190. That's 877-518-9190. The gold market has taken off topside in a large way in 2020. If you want to take advantage of this sector, now is the time to subscribe to my gold report. The gold report took profits in 4 of its equities in the gold portfolio in the first week of January for a combined profit of 99.2%, with 2 positions left in the portfolio that have a profit of 67.5% as of January 7th. The Gold Report is a comprehensive look at the metals sector as well as the markets that move gold, which is the currency and bond markets. New subscribers get a 30-day money-back guarantee, so you have nothing to lose. Every Monday morning, I publish the Gold Report with coverage of gold, silver, bonds, the XAU, HUI, GDX, as well as more than 30 different mining equities. To see for yourself the types of profitable trades that are recommended within the Gold Report, sign up now by visiting TFNN.com. Don't miss out on the next great gold trade. Sign up today.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Trading Hour with Tom and Tommy O'Brien. Next.
Okay, folks, we're back. We're chatting with Bill Meridian, Cycles Research. Bill, you want to go on to the next chart?
Yeah, well, the point with the S&P daily was that one move down from an all-time high. That's the beginning of the correction. As Elliott taught us, it's either A, B, C. In other words, A down, B up, C down, or 1, 2, 3, 4, 5. So that's either an A or a 1. So they got to be lower prices to come. And if we go to the next page, you'll see all the Fibonacci retracements, the trend lines on here. But they should have blown this up a little bit. But what we have on the S&P, if you look back one bar ago, monthly, the S&P went to a new all-time high and then closed below the close of the previous month, which is a hook sell signal on a monthly basis. And to me, that's one of the most important things. And if you look down, a 38.2% retracement of the entire 2009 to 2020 rally would take the S&P down to 23,400, which I think we're going to touch sometime during the year, although it may not be now. But if we go down, now there's been, I mentioned this the last time, the market activity from November through January has been a key to the rest of the year. The reason for that is because I remember in New York or in Abu Dhabi, around Thanksgiving time, what do you think the market will do next year? We have to get ready for next year. How are we going to adjust the portfolio? And all those positions would be taken by mid-January. So prior to 1950, this didn't work. But since the institutions are now very strong, so they really control the market through the year. And if they're wrong, they are not going to, if January, February doesn't go well, they usually don't sell off all of their holdings. So that came in bullish for the rest of the year. But now what has happened, and there are only 10 cases that I could find, when the Dow Jones has been down in both January and February, the index has been down for the year. I think that's 10 out of 10 times. There's only 10 cases. So the situation is quite mixed, but I'll clear it up if you go to the next couple slides. I think I showed this the last time I was on. This is the NASDAQ daily, and it shows a hook sell signal. In other words, it went to a new high intraday, but closed below the close of the prior day. It didn't do it once. It did it twice. And this is the reason I was so bearish for early February. And if you go down one more, now let's look at the updated monthly chart of the NASDAQ. There you get what you saw on the S&P, a monthly hook sell signal. It went to a new all-time high, then closed below the close of the prior month, and look how overbought it is. So these, to me, are the most important things I'm focusing on, and they point down. And I threw in something from left field here, the Sero cycles. This is from, I've written a political column for Del Horoscope magazine for 30 years, and unfortunately, March, April will be their last issue. They are folding up. This is
really?
From,
my goodness.
Yeah, they lasted
Wow.
84 years, Larry, one Uranus cycle, and I wrote for them for 29 or 30 years, which is one Saturn cycle.
Wow.
And so this is from the January, February. I did an annual forecast for the year. And I wrote, Saros cycles 137 and 142 are active this year. Now, Saros cycles run about 1,300 years. There's one every 18 years. And the eclipse shadow shifts backwards west 120 degrees for each eclipse in a cycle. So if you go 120 over 18 years, 120, 36 years, and 120, 54 years, they're visible from the same place on the Earth. That makes a 54-year cycle. So if you look back 54 years ago to 1966 on Wall Street, a 25% decline began in February. And on August 31, 1966, Mao called for the Cultural Revolution, which led to chaos in China. So here you have the market beginning a decline in February, and what do you have in China? But as you recall, I was already saying, if you remember my last few times you had me on, I said that Pluto was going over Jupiter in the Chinese horoscope for the current communist government, and that usually leads to bankruptcy or financial stress. I did not know there was going to be a pandemic. So, so if we go down just one more.
Bill, you mentioned the word pandemic. Do you think that's what we have right now? They just haven't announced it yet?
Well, let's get to the end of this so I can get this all in,
Bill.
because I have a lot of slides, and I don't have a lot of information on that. Well, this is similar to the 2000 top. I just got an email from Felix Zuloff, and Felix was managing a technology portfolio just like I was, but he was wise enough to do it from his own company, and I was working for somebody else, which was a mistake. And I remember he came to my flat in Abu Dhabi in 2000, and we both agreed that this was a high. And he just sent me a message. This looks an awful lot like 2000. Optimism is too high. Speculation is rampant. And the stock market is led by large cap tech stocks. And if you go down one more, if you want to compare this to prior bubbles, the red line is the current bubble. And you can see that each subsequent bubble requires more and more credit and more money to push the indices higher. And that, where you see that red line, that's the border collie and the Chinese porcelains and Babe Ruth's baseball bat and, banana taped to a wall and, all that artwork that's selling for huge amounts of money. So now it's kind of a key month for bonds. If you look at the bonds, this is the histogram of annual expected return. In other words, the percentage that the market is up or down multiplied times the change, whether it's plus or minus. So it's annualized expected return. And look at the month of March. It is the single most bearish month for bonds. And this is a little out, but if you go down one more, as you can see, the weekly bond cycle has already topped, although the bonds have surpassed this a little bit with the surprise rate cut by the Fed. So if you go down one more to bond considerations, March has only been up 7% of the time for a return of minus about 84 basis points. If the month of February has been up, which it was, March has been down 17 out of 20 years. Now it's 85%. So my conclusion is by the end of the month, notes are going to be lower. But of course, as if the stock market declines, the bonds tend to rally. And so most of this gain may come in the second half of the month, which I did not expect originally. And so just to go over gold, you see March is the weakest month for gold, but I'm not too concerned about that because this is an average of all years from 69 to the present. And if you go down one more, Larry, we should be on page 22, which is weekly and monthly gold cycles point up. That's just it.
Yeah, I got it.
The weekly and monthly cycles have been synchronized. They go up together, they go down together. So according to the cycles, you don't have any real concerns if you're holding gold until the month of May. So, and if you look below the technicals, the gold breakout, which is the next page, and you see a big rectangle. And if you break out of a rectangle, you broke out, tested the top, rallied, came back, sort of tested it again. So this is why I'm saying that I don't think gold is going below 1,500, 1,560, because it won't do that in a bull market, which the cycles indicate we're in. And where should it go? Well, the height of that rectangle, 1,550, add 300, you get 1,850. So I think that's the next target for gold. Oil is the reverse. Oil, the weekly cycle is headed down, You see that here on page 24. And if you go to the monthly cycle, it's also headed down most of the year. Now, what's offsetting this, which I'm not showing you, is March and April have historically been the two most bullish months. We got to go sell something.
Yeah, stay with us, Bill, please. Yep. Bill Meridian, Cycles Research. We'll be right back, folks.
I'm certain you are or strive to be one of the best at everything you do in life. It's the most common trait that we tigers and tigresses share. If you're looking to become the best of the best when it comes to managing your money, let me teach you to do what most wealth managers tell you can't be done, which is how to time the markets. I'm Steve Rhodes, author of Mastering Probability, and for the last 12 months, Timer Digest has been tracking my newsletter signals, which have earned me the ranking as their #1 market timer in the nation for the S&P 500 for the last 12, 6, and 3 months. Timer Digest also ranks me as the #1 market timer for gold as well. The fact is, markets can be timed, and I'll teach you the exact set of tools that I use that has transformed me into one of the best at what I do. Sign up for Mastering Probability today by clicking on the newsletter tab on the homepage of TFNN.com and get immediate access to workshops where I take you step by step how to use an extraordinary set of tools as well as provide great market calls too. Sign up today.
If you haven't checked out the newsletters page of TFNN.com, what are you waiting for? All of the TFNN newsletters are informative, up-to-date, affordable, and a must-have for every trader looking to gain a competitive informational edge in today's markets. TFNN newsletters cover every aspect of the markets to offer you the very latest in market news. Plus, new subscribers get to test drive our newsletters risk-free for 30 days. From all aspects of the markets, including stocks, bonds, metals, commodities, and tech, there's a newsletter to fit your needs exclusively from TFNN. Stay informed each day you trade and get that competitive edge that will help you stay ahead of the game. Visit our newsletters page by going to TFNN.com and click the newsletters button near the top of the page. TFNN.com, educating investors.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back with Bill Meridian. Bill, we're still on. Go ahead, my friend. Continue on. We were talking about oil. We're on oil. Go ahead.
Oil monthly cycle points down. The weekly cycle is about to turn down. Now let's go to the technical charts. Daily, you see it broke down to a new low. I covered my shorts, but it's rallying. I don't think it's going to get through 53 on this run. I think it's petering out right now. Mm-hmm. And I think it's going to turn lower. Let's look at monthly oil. Do you see where I have the
yep, just a second. It's page 27, yeah. Gee, you only gave us 30 slides. Thank you very much. Go ahead. Fire away, buddy. Go ahead.
We have extra slides here in Austria, so we're giving them away now. And we've gone up. You see that 5 up there. Then it went A, B, C. And look at the lower highs going back all the way back to 2008. And look at the momentum. The green line below that, that's sloping off. So this looks very weak. I would not be surprised to see it go back to level C there, which is about $25 a barrel. And by the way, that 2007 or 8, that is when the commodities and the oil did a monthly hook sell signal, the ones that I pointed out in the S&P and the NASDAQ, and it was the late Paul McRae Montgomery in his weekly letter pointed this out to me, and I called him up. And I said, gee, that's the commodities rallied to a new monthly high and closed at a new low. And that was that big smash in oil and commodities in 08. So these things on a monthly basis are rare, but when they occur, they're pretty deadly. So now you asked me about the coronavirus. I really have done no work on viruses, but I had said that the Jupiter-Saturn conjunction this year would somehow disrupt the economy, but I couldn't figure out how it would get disrupted because I don't think the current administration is going to back off on their business-friendly policy. And so I think it's the virus. I think it is going to obviously hurt economically, especially, of course, cruise ships, resorts, things like that. And that's the shock that I was picking up in the Jupiter-Saturn conjunction isn't until December, but it's already started to have an effect. And if you look in there, I looked it up last night and I sent it to my friends. There's Neptune in there, and the formula reads epidemics. So I think it's going to go global, yeah.
Thanks, buddy. Appreciate it. Bill Meridian, Cycles Research.